Did you know that over 80% of retail investors lose money in the stock market? But why? And more importantly, how can you avoid their mistakes and start making profits instead? Stick around, because in this video, I'm going to break it all down for you. Oh, and before we dive in, make sure to hit that like button and subscribe for more investing tips. Time is money, so let's get started. Mistake number 1, chasing hype and FOMO. Ever heard of someone buying a stock just because it's trending? Yeah, that's a recipe for disaster. Take Dogecoin or meme stocks, for example. People buy high, panic, sell low. Always do your research before investing. Avoid the hype and FOMO. Mistake number 2, trying to get rich quick. Too many people think the stock market is a casino. They jump into day trading or risky options without understanding the game. In fact, 90% of day traders lose money in the long run. Focus on long-term investing instead of chasing quick gains. Patience and strategy lead to long-term success. Mistake number 3, lack of a clear strategy. If you don't have a plan, the market will eat you alive. Most people buy on emotions and sell out of fear. Have a clear entry and exit strategy before buying a stock. This will help you stay focused and avoid costly mistakes. Mistake number 4, ignoring risk management. Risk is part of investing, but if you don't manage it, you'll blow up your account. For example, investing all your money in one stock. The solution? Diversify your portfolio and use stop losses. Always remember, managing risk is crucial. Tip number 1, invest for the long term. The stock market rewards patience, not panic. Stay invested through the ups and downs. Just look at Warren Buffett and other long-term investors. Index funds are a great starting point for beginners. They offer diversification and lower risk. Tip number 2, follow a proven strategy. Successful investors have a strategy, whether it's value investing, growth investing, or dividend investing. Find a strategy that fits your goals and stick to it consistently. Tip number 3, control your emotions. Markets go up and down, often unpredictably. The key is to stay disciplined and stick to your plan. Pro tip: turn off the news when the market crashes. Panic sells kill portfolios. Practice mindfulness and deep breathing to manage stress. Tip number 4, keep learning and improving. Read investing books like The Intelligent Investor and One Up on Wall Street. Follow reputable investors, not hype-driven influencers. Attend webinars and seminars to stay updated. Now that you know the biggest mistakes people make and how to avoid them, it's time to take action. What's the biggest mistake you've seen in the stock market? Drop a comment below. Subscribe for more tips and strategies to master the stock market. Mistake number 5, overtrading. Overtrading can lead to high transaction costs and poor decision-making. Stick to your strategy and avoid making impulsive trades. Remember, patience is key in the stock market. Make thoughtful, well-researched decisions, and stay disciplined to avoid the pitfalls of overtrading. Tip number 5, diversify your investments. Diversification helps spread risk across different assets. Don't put all your eggs in one basket. By investing in a variety of stocks, bonds, and other financial instruments, you can protect yourself from significant losses if one particular investment underperforms. Remember, a well-diversified portfolio is a key element in reducing risk and achieving long-term financial success. Mistake number 6, not rebalancing your portfolio. Regularly rebalancing your portfolio ensures that your asset allocation stays in line with your investment goals. Over time, the value of different investments in your portfolio can change, causing your asset allocation to drift away from your original plan. By periodically reviewing and adjusting your portfolio, you can maintain the right balance of risk and return. Don't let your investments go unchecked. Make rebalancing a regular part of your financial routine. Tip number 6, understand tax implications. Be aware of the tax implications of your investments. Tax-efficient investing can save you a lot of money in the long run. Different types of investments are taxed differently, and the timing of your trades can also impact your tax bill. Make it a habit to consult with a tax advisor, or do your own research to understand how taxes will affect your investment returns. By being tax-savvy, you can maximize your profits and keep more of your hard-earned money. Mistake number 7, ignoring fees. High fees can eat into your returns. Look for low-cost investment options to maximize your gains. Many investors overlook the impact of fees on their portfolio's performance. Whether it's management fees, transaction fees, or advisory fees, These costs can add up over time and significantly reduce your overall returns. Always compare the fees associated with different investment products and choose those with lower costs. By being fee conscious, you can ensure that more of your money stays invested and working for you. Tip number 7. Stay informed. Keeping up with market news and trends is crucial, but it's important not to let it dictate your investment decisions. The market is filled with noise, and not every piece of news will impact your investments. Use information to make informed choices, rather than reacting impulsively to every headline. By staying informed, you can better understand the market environment and make decisions that align with your long-term strategy. Remember, knowledge is power, but only when used wisely. Mistake number 8. Following the crowd. Just because everyone is buying a particular stock doesn't mean it's a good investment. Herd mentality can lead investors to make poor decisions based on hype rather than sound analysis. Always do your own research and make independent decisions. Remember, successful investing requires a disciplined approach and a willingness to think for yourself. Avoid the temptation to follow the crowd, and instead, focus on what makes sense for your individual financial goals and risk tolerance. Tip number 8. Have patience. Investing is a long-term game. Don't get discouraged by short-term market fluctuations. Stay focused on your long-term goals. It's easy to get caught up in the daily ups and downs of the market. But remember, the most successful investors are those who stay the course. Patience is a virtue in investing, allowing you to ride out volatility and capitalize on long-term growth. Keep your eyes on the prize and remain committed to your strategy, even when the market gets choppy. Mistake number 9. Not having an emergency fund. Before you dive into the world of investing, it's crucial to have an emergency fund in place. This fund acts as a financial safety net, ensuring that you won't have to sell your investments in a pinch when unexpected expenses arise. Whether it's a medical emergency, car repair, or sudden job loss, an emergency fund helps you stay on track with your investment strategy without the pressure of needing immediate cash. Remember, investing should be a part of your financial plan, not a replacement for financial security. Tip number 9. Seek professional advice. If you're unsure about your investment strategy, consider seeking advice from a financial advisor. They can help you create a plan that aligns with your goals. A professional can provide insights and guidance that you might not have considered, ensuring that your investments are well structured and diversified. Remember, there's no shame in asking for help. It's a smart move that can save you time, money, and stress in the long run. Your financial future is too important to leave to chance.